Hey everybody, it's Daniel here from Infrares. Hope you're all doing well. So, I did a video yesterday talking about Bank of Canada, whether they're going to cut interest rates in 2024. Gave my input on it, saying that, hey, guess what? The global central banks out there all coordinated, even though we heard the ECB, European Central Bank, and Bank of Canada lean towards more on the hawkish side, pushing back on the idea of rate cuts. Lo and behold, after I posted that video, there was an article from Bloomberg, and actually Macklem came out, and the article basically discussed that Macklem actually said that, you could see rate cuts in 2024 after, during the last video that I posted, he was really against that idea of rate cuts slightly. Again, more on the hawkish side, but didn't make it clear that 2024 we would see rate cuts. But then after some time, he came out again and he basically clarified that 2024 we could see some rate cuts, but just not so soon, later in 2024, right? Still leaning towards the hawkish side of things, but hey, open the door just like the Fed did for future rate cuts to come in. So I'm just going to read a couple of things here. It says here that Tiff Macklem spoke in an interview with Bloomberg on his policy outlook in 2024, suggesting the bank rates are likely to be cut, but was vague on potential timings. So he said, if you look at our projection, it's sometime next year, but I'm not going to put it on a calendar. So again, still leaning towards the hawkish side of things, but however, he is saying that, you can expect some rate cuts next year. Now, market analysts are tipping cuts from bank in Q2 or Q3 of next year. And again, it's going to be all dependent on how fast this inflation number comes down, and dependent on, like I was saying in my last video, about the hard landing, about any issues in the economy, a recession that we see in the economy. How bad does it get that requires Bank of Canada to cut rates? Now, at the same time, also, you may not think or see anything bad happening, but behind the closed doors, right, in terms of liquidity in the banking sector, if that starts to get worse and worse, you may not hear about it right away, but then that would also trigger the central bank to all of a sudden start cutting rates. Now, it's very important. Keep this in mind, right? Tiff Macklem right now is saying that he's very hawkish, right? He's on the hawkish side of things. He's saying that, okay, we can expect some sort of rate cuts next year, but he's saying, I'm not going to put it in the calendar. And he said that, also told us, we've heard that very unlikely it's going to happen anytime soon because wants to see the inflation numbers come down. It'll be interesting next year. If there is some sort of issue in the banking sector when it comes to liquidity, right? Not just in Canada, but worldwide, in the US and so on. And we're already seeing signs of this. We're seeing signs of liquidity pressures in the banking sector, in US, in China, and other economies as well. And it will transition globally. The global liquidity system will all be affected once, things start to get worse off. So it'll be interesting. Why I bring this up is it will be interesting because right now, today, we hear Macklem on the hawkish side of things. It'll be interesting because when he comes out, one of those meetings, he's going to completely flip and he's going to start sounding on more the dovish side of things, saying, okay, yeah, we start, our members, and we had some meetings and we started talking about potential rate cuts and blah, blah, blah. And then, let's say the Fed cuts rates first, and then they're like, yeah, the Fed, they cut rates, we are still thinking about it. And then maybe in the next meeting, he'll start to say, okay, it's time to now pave the path for those rate cuts. Let's not forget also that they've been in pause mode since September, similar like the Fed. So what happens in these cycles is that when you get all these rate hikes, then the pause tends to last between 6 months to, let's say, a year, and then from there you get the cuts starting to come in. So what's next is the markets very, very much know, and don't get me wrong, Macklem knows also. Don't think that he doesn't know when rate cuts are coming and whether rate cuts are coming. He knows very damn sure that rate cuts are coming next year, especially if things are gonna get worse off. Again, the liquidity problems in the banking sector behind the scenes, right? The things that you and I can't really see. I mean, there are some metrics we can look at, but what really goes on behind, other than the online metrics that we can't see. The central banks can. They probably know more than what we know right now. Now, adding to all of this, Macklem also said that we're focused on core inflation. That's what he said. When it comes to cutting rates, he also said that Bank of Canada need to see here's the thing, a number of months with sustained downward momentum in core inflation before it cuts interest rates, right? So that may mean that, okay, they may not cut right away, but they may cut interest rates, maybe third, fourth quarter of next year after seeing many, many, many months of core inflation coming down. Now, he didn't specify how many months, but he said a number of months, right? Which could mean one thing, that they could also be late to cutting interest rates if things are getting worse off too early on in 2024, right? Again, we will see what happens. He also mentioned, we are certainly feeling more confident that monetary policy is working, and increasingly the conditions are in place to get us back to 2% inflation. Remember, the target's 2%. They're not adjusting to 3 or 4 or whatever. It's 2%. But that is not yet assured. We're not there yet. There are a few more things we need to see to be more confident that we're headed back towards 2%, and we're watching those closely. So again, like I said, on the hawkish side of things, rates continue to be unchanged around the 5% level. Haven't been adjusting anything of the rates since September. And, after being really hawkish in the beginning, we hear that, Macklem is now starting to say, okay, you can expect something in 2024, but not very fast. Again, we need to see the inflation number continuously come down in order to be confident, right? So putting the hawkish side of things, because he doesn't want also Canadian bond yields to drop too aggressively low, because that will create easing conditions already, and they don't want that, right? So another thing that came out today is inflation, right? Canadian inflation, Canadian CPI. So this news came out basically yesterday around 5 o'clock-ish, and we got CPI inflation that came out today in the morning. Now this is very interesting because this kind of puts the narrative, kind of supports what Macklem was saying. And what was he saying? He was saying that, hey, what was the inflation number saying? The inflation number was saying that, the number came in a little bit hotter than expected, which was 3.1% year over year versus 2.9% the estimate number, right? So again, going over the core number, because that was the year over year number, not the core number, but the core number is the year over year core number is 2.8%. So the number I gave before was actually the headline number, 3.1%. That's what you're going to hear in the media and everywhere. That's what includes basically gasoline, oil, etc., etc. But the core number takes out the energy component, and that came in 2.8% versus the expected 2.7%. So remember, like I just said, Macklem said that they're going to be focusing on the core number, right? The core number that came out higher than expected for this report. Came out at 2.8%, so actually higher. And the expectation was 2.7%, right? And the headline number, of course, also came in higher, 3.1% versus the expected 2.9%. Now, what was the contributing factors of this? Grocery prices. Grocery prices continue to rise. Overall grocery price increase, the increase did slow down, but it still increased, right? In November, the rate of increase in grocery prices slowed to 4.7% compared to October, which is 5.4%, but still up on the month, 4.7%. So it's still creating that pain for a lot of consumers out there who are feeling it when it comes to spending money for their food, for their essentials from the grocery shops. The 5-month trend for grocery, the it has been seen 5 consecutive data points where it has been slowing down the price growth, but the growth is still there, right? The 4.7% is still a large number, but it's slowly coming down, right? And again, what factors might be contributing to the slowdown? It's the slowdown in certain items, slowdown in the demand, slowdown in feeling the pinch, the pain, right? All of this is a factor of it. But to go more in specific, non-alcoholic beverages, those decreased the prices by 0.6%. Fresh vegetables, prices increased, but at a lower rate of 2.5%. And other food preparations, prices increased by 6.4%, but again, slowed down. So these were the items that were slowing down. But the reason why they're still up today, even though it's slowing down, still grocery prices are up today because the contributing categories that have seen fast price increases are meat. Meat rose by 5%. Preserved vegetables and vegetable preparations, prices increased by 5.8%. Sugar price saw a significant increase of 8.3%. So these are items that are actually pretty important when it comes to the consumer's consumption, and those components increase, which is why we saw the overall grocery prices still be elevated, right? We still see the prices are still up there, even though the growth trend is coming down, but it's happening very slowly. Because again, at the end of the day, groceries is very important for everyone. Food is very important for everyone. This is something that you can't really compromise too much. You can make adjustments here and there, but you still got to eat, right? So okay, you're maybe not going to expensive restaurants. You're probably not going to buy those expensive food items. You're going to look for alternatives. Maybe you're going to eat some beans instead of meat, whatever the case may be, right? But you're still going to shop to eat because you need to eat, right? So that's why the slowdown is not that slow. That's why the prices are still up in terms of the grocery prices, and it's going to take much more in terms of the demand getting hit in order for these prices to come down. But it's happening, but at a slow pace. Now, service prices remain elevated. Services price remained elevated in November. Service prices rose by 4.6% year over year, consistent with the increase in October. We saw significant price increase in travel tour prices. Main reason largely due to events in destination cities in the U.S. during November. So okay, holiday seasons, etc., starting to pick up for tours. Totally get it. And then there was also a decline in cellular services prices. Significant drop there, where it dropped by about 22.6% compared to November 2022. And energy prices overall also have declined. We know that. We've been seeing energy prices decline, even though there's some news to argue and some data points there to argue that prices should be higher. But because of the demand shock that the markets are pricing in, because of the demand crunch the markets are pricing in, right? That is feeding into the current prices of oil. Although we had recent news that caused oil to pop up, but overall it's been declining because the oil market is pricing in that demand is getting weaker, and if demand is getting weaker, the prices will start to move down, which it has been over many months, and that's why you see it also in the CPI prices coming down. Now, there's also been an increase in electricity prices. Electricity prices increased by 8.2% year over year compared to October. This was higher increase than the 6.7% in October. And the rise was mainly due to higher prices in Ontario, which Ontario saw about plus 7%, linked to increase of time of use rates. So people are using more electricity, right? Is it really time of use? Is it something else? I mean, who knows, right? Everything has been rising, especially in Canada, with certain items that is affecting the consumer even further. So, anyways, overall, so going back, looking at what Macklem's been saying, looking at the CPI, the CPI does the CPI numbers that came out today does support what Macklem's been saying that we need to see a couple of months of the inflation number to come down. He's still on the hawkish side, which is why you're seeing the CPI number not moving down as aggressively, and it makes sense. However, the trend has been moving down since the past couple of months, from the 8% level and down lower, which gives Macklem the reason to say that you could see rate cuts in 2024, but just not early on. We need maybe later on, that third quarter, that fourth quarter. He didn't say third, fourth quarter, but the markets are pricing in, or the analysts, I should say, are pricing in that the rate cuts are probably going to happen around there, third quarter, fourth quarter, right? And by then, will we start to see the economy start to really deteriorate in terms of the growth? And then by then, will we also see the CPI get affected? These are all things that we will be watching out for 2024. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.